We have to connect both of them. So thank you, Dr. West. Canterbury, it's amazing to hear the work that you all are doing. And now we know the part that we can play. We have to amplify those voices. We have to be advocates for those who are not present in the room. We have to create a table that involves everyone. So thank you. At this time, we're going to get to our next speaker, and that is Sam Evans. Evans is a community development advisor for the Federal Reserve Bank of St. Louis. In this role, she fosters collaboration and conducts research and analysis on a variety of topics pertaining to workforce development and job quality. She currently serves on the Arkansas Community Development Society Board of Directors and sits on the University of Central Arkansas's Community Development Institute's Advisory Board. Prior to joining the Federal Reserve, Sam worked as a program officer with the Winthrop Rockefeller Institute. Sam holds a certification in strategic doing from Purdue University and is a professional community and economic developer. She received her graduate degree at the University of Minnesota in urban and regional planning, and also my Spelman sister, a bachelor's degree from Spelman College in Atlanta, Georgia. Please welcome Sam Evans. And just as we had it already queued up, the computer went to sleep.
Well, good morning or good afternoon. I guess it depends on if you've had your coffee or not. I am just so elated to be able to be a part of these conversations for a myriad of reasons. So far this morning, the conversations have been really robust, as well as knowing that many times people normally do not connect the Federal Reserve to this segment of work, to small business development. And so we understand that you as small businesses and our small businesses in this community plays a critical role in our economy. And so we know here, even in Arkansas, that a majority of our small businesses actually employ over half of the private sector workers. And so we know that how much you contribute to our state and local economies while also helping to both drive innovation and meeting community needs. But given this national significance as well, we know how important timely information, and so glad and happy to hear about from Dr. Sharice about the data work that she was providing around ALICE. And so I'll also be kind of sharing with you all some economic conditions, financing needs, credit availability to lead into our next panel. I think that will be pertinent for our small businesses development. And so I will spend a large portion of my time sharing with you about our most recent survey, which was a national sample of over 8,000 employer small businesses. So if we have time today, I do hope to answer any of your questions or be able to find those that can be able to share with you some of those questions if I'm unable to answer. Okay, so quickly an agenda. I'll just give a brief overview about the Federal Reserve and why economic equity matters to us, and then provide you with some community development resources as you're thinking about not just building up small businesses, but actually doing the work in community and with community, as well as a few key takeaways from that small business credit survey I was discussing. But before I begin, I must give this disclaimer. So if you've seen anyone from the Federal Reserve, you've probably seen this disclaimer. So just want to let you all know, I'm speaking for myself and myself only. I do not speak for the St. Louis Fed or any other federal agency or organization, but just speaking for myself today. So a little bit about the Federal Reserve. So we serve as the central bank of the United States. You can really think about that as having the responsibility, one, of monetary policy. So thinking about maintaining full employment or maximum employment in the United States, as well as maintaining stable prices. We are also responsible for the supervision of banks. and our payment system. So really trying to make sure in a couple of ways that the money that is kept in banks, that they are remain secure and that banks are being responsive to consumers. So by ensuring that there's fair credit access and that banks are meeting their obligations on their Community Reinvestment Act, which is essentially asking them to invest or lend or provide back into their community at a proportionate rate that they're receiving deposits from that community. And so what a lot of people actually don't, may not associate with the Federal Reserve is actually our community development work that we do. And so within this work, we're really working to promote resiliency and mobility for low and moderate income, as well as underserved individuals and communities. So in a way of how we really kind of think about that work is really thinking about, as an institution, about how we can be able to foster economic growth. So really understanding that economic growth doesn't always happen proportionately in every neighborhood or in every region, or even in every household, as Dr. Sharice was talking about with Alice. And so we really understand that when the economy may be booming, it may not be felt by everyone. And so what are some ways in which we can be able to think about those levers that we can maybe be able to pull, or some of those other drivers of opportunities that might be able, as you were talking about housing and then talking about what's happening in the Dunbar neighborhood, what are some ways in which we can activate folks being able to do more of that work? And so really being able to investigate how we can pursue that could help build economic resiliency and mobility for individuals and families. And being a part of discussions like this today is really some of those salient conversations that we're having across the country to being able to help folks as we're thinking about what's needed, but then also talking about what are the best practices, what are opportunities to being able to share to build up our community. And so through that, we do our work through our community and partnerships team where I serve, as you can really think about us as kind of being the boots on the ground, so really serving an outreach and engagement role on the side of the house. So we do that within 3 buckets, really engaging and convening to advance regional economic equity. So for instance, how that looks in Arkansas is that we were involved in understanding through workforce development roundtable. So we know that our unemployment numbers, as you all have heard earlier, they're really, really low, good for us, but we also notice that our labor force participation rate is fairly not in the best of shape to being able to match that, to really show that we're a robust economy. And so we know that that data point is just one number that kind of gets at that a little bit. And so what we did, we hosted these roundtables across the state to being able to, broker the information to enhance decision making, but then also build support around cross-sector collaboration. So being able to understand that data point, but then also understanding the stories behind that data point. What's actually driving that? What are maybe what are communities being able to experience, as well as what are some ways in which communities are working to combat that? And so we talked about childcare quite a bit. We talked about transportation. We also talked about FLIF benefits, so talking about those areas where folks may be losing a benefit if they were to take a job at a higher rate. And so talking with organizations that are working to ensure that there's not a cliff, so to speak, but maybe a map, and where folks are being able to understand those long-term opportunities. And so our vision really is around being able to have where everyone is able to participate and derive benefit from the economy. And so looking at how we can be able to address structural, historical, institutional, as well as even behavioral barriers that may inhibit full economic participation among people groups and communities. And I actually see some of our roundtable participants in the audience, so thank you so much for being able to participate and help us to being able to understand what's actually happening here on the Also, so I was talking a little bit about our engagement work, but we also carry out research, and that's through our Institute of Economic Equity. We see this as one of the key ways to where we can every Federal Reserve Bank across the country has these centers of excellence, or areas where they really focus in around research that may be able to help contribute to that region. And so we, as an organization, as a Federal Reserve Bank, really saw this as a key way for where we can be able to drive economic growth, is being able to understand what are those structural barriers to folks being able to participate in the economy. So both being able to examine as well as identify, as well as advance, because a lot of things we talk about what the challenges may be, but we were also hearing from folks that they want to hear about where the successes are as well, and so how we can be able to curate those conversations. So I will say, just kind of give a plug real quickly within rural communities. We're actually going to be talking about how communities are creating welcoming communities, areas of belonging in their communities. We're going to be doing that later on this fall, and hopefully I'll be able to share more information about that, and I'll connect with Amber here in the room about that. Also want to just be able to share just a few of the resources that we do have available. So one of those resources I was sharing with you is with our Fed community. So if you would entertain me for a moment and imagine where racial and gender labor market disparities don't exist. And so how much, we heard a little bit, Sharice kind of gave it away, how much do you think our state economy would stand to gain? Anybody want to give an answer? 2 billion, right? Talking about Alice. But what if we were able to remove all racial and gender gaps in our economy? Well, anybody else want to give another guess? I think it's a little bit higher. I heard of 40 million. 40 billion, not quite as much. Well, it possibly could be now. We actually, this is a thought experiment that we did with our Fed Communities group, where we really looked at highlighting data from 2005 to 2019. And so while we can't predict the future, we really looked at, we can really look at the past for clues, and that's what we do through our data. And so through this thought experiment, we were able to see that if Arkansas was able to close all racial and gender gaps, we could stand to gain 15 billion to our GDP. And so these economic benefits, as we were talking, really closing racial and gender gaps, would extend beyond not just the people that are experiencing those disparities, but it actually benefit us all. And so we know that every one of our community members, we have a role to play in examining those factors that constrain people from being successful in the labor force. And so when we're thinking about some of those factors we were talking about where folks aren't able to participate in the labor economy, that we don't maybe say out loud, including discrimination in hiring, workplace culture and policies. So we know we need to pay a living wage, right? But, and Sharice said, we're not even talking about benefits, but what are those ways and benefits that we need to be able to talk with our employers about being able to have so that everyone can be able to have and derive benefit in that economy, as well as lack of supports for families and children, such as childcare. So childcare right now, I know that whenever I was going through that situation, it was like paying for college tuition, right? And so what are some ways in which we can make sure and ensure our families don't have to go to where we, in our roundtables, we were hearing where families weren't, where folks were thinking about coming out of the workforce in order to be able to pay for, in order to be able to take care of their child, for one of the main reasons as to why they were leaving the workforce. And so that doesn't have to be, although it can be, if that's the route that families want to be able to go. But what are some options and ways in which we can be able to identify for folks to being able to share into that? And so some of these resources, as you go through and be able to connect with, hope that you're able to join the conversation and be able to provide for you as you're thinking about increasing opportunity in your community. And so real quickly, I just want to highlight the Small Business Credit Survey, which I think will be pertinent for the rest of the conversation, especially how many in this room are small businesses? Own a business? Yes? Quite a few? All right, great. So through this, we really hope, we're actually about to field our next 2023 survey, so I'll definitely be in contact with you all later on to being able to get your thoughts as well. But this is kind of a part of the work that we do by encouraging small business development, particularly for those that may have seen this as an opportunity, as we saw in our workforce development roundtables. A small business development was seen as an opportunity as folks were moving out of the labor force and creating jobs for themselves and seeing entrepreneurship as a way to build wealth and legacy for their communities. And so we definitely have work to support that. We also have a supplier diversity program as well that we work within even our own bank to being able to investigate how we can be able to support that work. And then we also do that through this research. And so we conduct surveys and research on small business needs and financial experiences. So kind of just want to highlight a few of those key takeaways. So here you can see that the 2022 survey, we see that businesses are charting their way through the lasting effects of the pandemic, or we still know that it's still going on. And so how our employers indicate that this recovery actually has been uneven for small businesses. So like not everyone is experiencing the economy boom, that also goes for our small businesses as well. In the 12 months leading up to the 22 survey, many firms experienced growth in revenues and employment, but their expectations for future growth are lower than in 2021 survey. And small businesses continue to face operational and financial challenges. And with the end of government funding programs, applications for traditional financing actually has increased. And so kind of want to take some of these key points and provide a few data points on that. So looking at this first chart here, we see that 44% of small businesses had increased revenues in 2022, while 29% added employees. So that's a really good sign. And for the first time since 2019, more firms were reported growth than declines in revenue and employment during the prior year. And so, and I will note that this survey actually is looking at small businesses, employer firms, so those that actually do have employers. We did do an additional survey addition to that, which you can be able to find, and I can connect you if you want more information on that. But I think this is really telling. But then whenever we look at this diffusion index, we see that since then revenue and employment growth has continued to improve and tipped into the positive, but they remain well below pre-pandemic levels. So there's still a gap there and still some work to be done. So when talking to our small businesses about what the operational challenges were and what their top ones were, we see that hiring or retaining workers and supply chain disruptions were it. Of course, this does not represent all sectors of our small businesses, so I do want to make that clear. But for the majority of those, similar to our large industries, and when we were talking in workforce development, hiring or retaining qualified staff, and we could potentially look and dive a little bit deeper in the charts and talking about, while some were able, in order to meet that, they actually raised wages in order to be able to hire and retain their qualified staff. I will say that across all 3 years, hiring has been more difficult with a little decline in 2022 and 2021. And of course, rising costs or inflation, shown here as rising costs of goods, services, or low wages, was the most widely experienced financial challenge for small businesses in 2022. So that puts the onus on us. We got some work to do as well. And so around 4 in 5 of firms cited challenges related to rising costs. So we know that small businesses have been hit hard by cost increases, which is one of the many reasons why the Fed, we still remain focused on inflation. And so then whenever we talk about reliance on personal sources, we see that respondents were more likely to use these funds from their owner savings or friends or family, or even government funding sources to being able to rely than on financial institutions. And so this isn't surprising given, the Paycheck Protection Loan or even the EIDL, the Economic Injury Disaster Loan. So we know that that was there. And so these loan programs actually cumulatively supplied over $1 trillion in support for local and small businesses. But we know that as these programs have ended, including the SBA program, the EIDL, here, we know that that's probably going to go down even more so. And so what are some ways in which financial institutions can be able to understand that data that we do have to being able to provide areas of focus for the community they serve? And so we also see that that this varies across demographic characteristics. So whenever you break out and disaggregate the data, which we've started to encourage more and more so as we're doing these surveys, that even women-owned firms and younger business owners were more likely to rely on their own personal sources of funding rather than their counterparts. And importantly, these differences are explained, at least partially, by differences in firm size and age. So Black and Hispanic-owned firms tend to be smaller and newer, for example, than white-owned firms. And women-owned firms are typically newer and smaller than men-owned firms. And so firms that are starting out and those that are very small tend to have shorter credit histories and fewer financial service relationships. And there could definitely be, we know, understanding of what that could potentially be, but I'm just focusing on being able to hold up this data that we highlighted here. And so that's one of the parts where we give back to our economic equity folks and our researchers, be like, hey, we need you to investigate what's really happening here so we can be able to call it out. And as programs become less available, we see that fewer firms turn to pandemic-related funding in the past 2 years. So we're already seeing that on the decline. And so while 77% of firms saw pandemic-related funding in 2021, just 34% of respondents down here, as you can see, within our recent survey was applied. So conversely, while over here you see on to the left of our 2021 survey, they actually were even able to receive pandemic-related financial assistance in 2021. And so 31 received those funds in 2022. So there's quite a bit of disparity that we see there in 2021. We've heard quite a bit of news and conversation around that. And so being able to highlight to try to get those gaps closed there. And so the SBA, I just wanted to highlight this too because it was one of the most common type of financial assistance that was sought in the prior 12 years. And so here we see that around 23% of the employer firms indicated they applied. And 2 in 3 firms sought no pandemic-related financial assistance in the last 12 months leading up to the 22 survey. And so then when we're looking at firms most often turn to large and small banks when applying for financing, we see that there's definitely different factors influencing why firms applied to each and differed, right? And that one of the most common reasons firms applied was because they had an existing relationship with the lender. And so as we're going into the conversation with our CDFIs, we see here too as an opportunity where folks can be able, employers can be able, or small business owners can be able to understand what CDFIs can be able to provide for them, which I think is a helpful conversation. I wanted to include that. And so when we look at the top factors influencing where firms apply were existing relationships and expected speed of funding. So across applicants from large banks to small banks and lenders, the factors influencing why firms applied to each, we see that there, like I mentioned before, there was a difference. And so I kind of just look here where it kind of highlights that there's that speed. And so while you see that one of the largest factors for like the online lenders was around that speed, that actually whenever you looked at the satisfaction from respondents, they were actually more dissatisfied with those online lenders because of that conversations characteristics around that relationship that they didn't have. So while speed is good, and that's what folks are wanting and needing, I think it's a good indicator for our small bank conversations here, our community banks, to being able to understand that these firms, while they're wanting that speed, but they're also wanting that consistency and that relationship and that still closeness, getting with our small. And this too is kind of what I wanted to highlight too, is that when we disaggregate the data, we see that declines varied by race and ethnicity of the owner. And so Black-owned firms were the least likely to be fully approved in 2019. And in 2022, 1 in 5 Black-owned firms were fully approved compared to nearly 3 in 5 white-owned firms. And this is kind of the chart that I had highlighted before, so that's just a. So looking at approval rates, we see that there has been improvement year over year, but the share fully approved remains still below pre-pandemic levels. So this chart here kind of shows how access to financing has changed over time. Specifically, it shows that the shares of firms here that were fully approved or partially approved or denied for loans, lines and credits and cash advances that were sought. And so the green and yellow lines, they highlight the share approved for at least some financing. And we see that that's the highest since it's been since 2021. Yet we see too that, like I mentioned before, that it's still below the pre-pandemic levels. So with that, I'm going to close to highlight and share with you all some areas where you can go and find some more information. Like I mentioned before, we have data as well as chart books. So if you're data geeks here inside here who likes to kind of look at that, we do have that available for you to look at and check out, as well as information on our non-employer firms, which I didn't have time in order to be able to dig into today, but happy to be able to share and have conversations about more about that work. And then we have fedsmallbusiness.org where you can be able to connect and be able to talk more through that. But I'm happy, I'm here right downtown Little Rock to have one-on-one conversations about this if ever needed. And definitely encourage you all to connect with them. So I know that was a lot of datas and charts and a little bit of time and a little bit of information. But I just really kind of wanted to be able to see how we can be able to plug in some of those data points to lead into the conversation earlier. So thank you all.